Well, good morning, good afternoon, and a very warm welcome to today's executive dialogue on the global outlook for 2024. My name's Anthony Kennaway, and I'm the Head of Public Affairs and Stakeholder Dialogue here at Swiss Re. And I'm very pleased to be joined by three colleagues who will help us talk through this outlook. First of all, our Group Chief Economist and the Managing Editor of our Sigma publications, Dr. Jérôme Haegeli. Jérôme, welcome to you. The Chief Underwriting Officer for Specialty, Anne Lohbeck, and very warm welcome. And Julien Descombes, who's the Chief Underwriting Officer for the Life and Health business.
Hi,
welcome
Anthony.
to you all. And a welcome, of course, to the audience. Before we start, and we'll be talking for about 30 minutes on this webinar, what we'll do is we will have questions available, and you can write your questions in the side here on the Microsoft Teams Live question, and I'll pick them up here on this iPad. Please note that those are, this is a recorded session, and of course the questions are live as well, and so this is a matter of public record, just to warn you of that. So without further ado, we're going to go through this. First of all, we'll take the global economic outlook, and Jérôme, if you could give us an introduction to that, please, from your side.
Thank you very much. Great to be here. Thanks, Anthony and Julien. Wasn't long ago, we published our Sigma outlook, and the year is still fresh. Now, if you look at the global economic and insurance market outlook, and if you look at this cover image, yes, in terms of economic outlook, it is getting chillier. It has been chillier here also in Zurich last week. But I think what is really key is we need to differentiate the seasons on the economic front, where you are in terms of region, but also we need to differentiate the economic business cycle with the insurance markets one. In the insurance markets, we continue to have the positive drivers of higher rates as well as the positive drivers of disinflation. And I think this is something which is very markedly different, and this is something we also emphasize in our Sigma forecast. So let me walk you through in a few minutes to our key highlights in terms of economic and insurance market outlook as per our last Sigma, and also taking the latest information into account. I will share with you a few graphs as well as a table, but before doing so, let me share you, please, what we think is really the key letter when thinking about the economic insurance market outlook. The key letter, it's D. 2024 will likely be the year of disinflation. What is disinflation? Disinflation means that the inflation pressure, at least the economic inflation pressure, will be coming down. This is really positive for economies, purchasing power, for consumers, for real wages, but also for insurance market players when you think about the claims development. Now, one shouldn't, however, confuse disinflation with deflation. Disinflation is lower price pressure, but the price shock is still very much in the system, and we're not seeing and expecting negative price changes. Meaning there should continue to be high alert in terms of claims management. I think D is also very important when you think about demographics. Well, that's nothing new at all, for sure, but what is new is, coming out of the COVID crisis, we continue to see this structural shortage of labour markets in certain sectors, and that will take some time to normalize. But what's going to be new is that we have been coming out of this COVID crisis, and while interest rates at the long end of the curve are peaking, they will remain nevertheless higher for longer, and that's definitely positive for savings. And I think what's also not new, but which has been accentuated by the difficult geopolitical situations and also the continued war in Europe, is the D, which stands for decarbonization. We will continue, I strongly believe on that, to make progress on the decarbonization front. And decarbonization front is about greening the economy, so about opportunities. And I really truly believe there are lots of insurance market opportunities, both on the underwriting, but as well as on the investment side. And decarbonization and greening our economies is also about improving energy security. So that's why I think geopolitical risk actually rather accentuate these decarbonization efforts. So disinflation, globalization, as well as decarbonization, definitely important. I mentioned also demographics. deglobalization, that you can see with the changes in terms of trade patterns. Just as an example, you see now actually that Mexico, as an importing country for the US, is now as important as China. And that shifts in terms of trade flows I think is also something we need to keep in mind when you think about the market outlook. There's the last D, which is differentiation. We definitely need to differentiate the markets and the lines of business. Now, the key figure to summarize our outlook, it's number 2. Hope that's easy to remember, D and 2. 2, why 2? Well, for inflation, and inflation is and has been the number 1 risk for insurance markets. 2%, in our view from Sigma Research, we think this is rather going to be the floor for economic inflation, for consumer price inflation. 2, in terms of economic growth, and you will see that shortly if you look at our forecasts, our real GDP forecast, we see 2 being actually the ceiling for GDP growth. So there continues to be high pressure on the inflation front, and growth is slowing down. There's some recovery in some markets, but nevertheless it's slowing down, and 2% for advanced economies will be the ceiling. Now, how does this translate into insurance markets? And you will see that as well shortly. In terms of insurance market premiums, we actually are pretty positive. We see 2% being the floor for insurance market premiums on both sides of the on key lines of business, be it life or be it P&C. We expect global premium growth to be above 2% for this and next year. Now, with these highlights, let me quickly walk you through briefly on the broader economic outlook, and you see this in this table with the key themes, and the slides and presentation will also be shared after the webinar. Key points on the economic growth. Yes, we do expect global growth to slow down in 2024. Some of it is the lagged effect of the monetary policy transmission mechanism. Higher rate is not good for investments. Higher rate is good for savers, but for investments and for refinancing, it will make it more costly. We shouldn't also forget that the excess savings are being depleted. They are still here when you think about the consumption in the US, but the consumption growth, which has been extremely strong in the US, is going to come down. However, we are not expecting a recession, neither a mild recession in the US. For Europe, we have been expecting recession, and we caught a mild recession last year. 2024 probably will be more likely the year of stagnating growth in Europe. In the US, if you look at our forecast, growth is going to be much stronger than in Europe. However, if you compare our forecast to the growth momentum that we had in the 3rd quarter and that we will also have in the 4th quarter, it's a marked slowdown. It's almost halving, actually, the slowdown that we are seeing in the US. So we shouldn't be overly positive on the US either. Now, on the interest rates front, it's super important as well, right, for insurance markets. On the interest rates front, we do expect the Fed, the US Central Bank, as well as the ECB, European Central Bank, to be cutting policy rates. I see actually, and I would expect the Fed to be cutting rather sooner than later. If you look at the disinflation progress in the US, it has progressed more or less than expected, but actually better than the Fed anticipated. So there's good grounds to focus actually in cutting. And while 2 is the kind of floor for economic inflation or CPI, we shouldn't forget the Fed also has a dual mandate, so it's another 2, and they don't just focus on inflation, but they also focus on growth and the labor market. And probably on the labor market front, we are seeing more weaknesses than the headlines might suggest. Now, translating again to insurance markets, on the growth front, on the insurance market premiums, it's a stronger insurance market environment, no question about that. We forecast over this and next year about 2.2% of global real premium growth. Nominal terms going to be much higher, but in real terms above 2%. That's higher than the average 5 years, but still below the pre-COVID crisis momentum that we had been seeing. On inflation front remains super important. On inflation, as mentioned, disinflation. But there's also going to be rotation, and there's going to be more stickiness in wages and service price inflation. So it's important to differentiate there as well. In terms of market momentum, I would expect the hard market momentum that we see in the insurance market to be easing somewhat, but I would characterize it definitely as a firm market. Interest rates, this is a really positive driver. 100 basis points improvement in the interest rates front, it actually leads to a decline in combined ratio of almost 300 basis points. And you see that the return on equity, it's moving up greatly. It's about 10%. That's our forecast for 2024 and 2025 for the primary P&C industry. However, at the same time as interest rates went up, the cost of capital also went up. So we don't expect 2024 or either 25 to be the year where the direct insurance market industry is able actually to earn its cost of capital. The gap will be reduced, but not yet in a position to earn its cost of capital. But definitely, direction is the good one. Well, risks are plentiful out there. Mentioned inflation, mentioned briefly also. It's a big election year, so there's definitely plenty to watch. A lot of hot topics and policy shifts as well, which we should keep in the forefront. And the other points, inflation, interest rates, as well as the volatility and uncertainty, for sure, will keep us busy. With this kind of broad overview, very happy to pass over to you, Anthony.
Fantastic, Jérôme. Thank you so much, and a very, very textured view there, I think. So let's get into the business a little bit, and if we could start with you, please tell us what are the implications of this for specialty?
Yeah, happy to speak to that, Anthony. Thank you. So, if we go with one of the specialty lines of business engineering and we look at the inflationary tendencies, even if, as Jérôme outlined, they may not be moving downwards towards disinflation, but simply easing, we see patterns that we need to manage and that we need to work through. So look at engineering, where we've seen rising costs for materials, rising repair costs. We've also seen shortages in available labor, so skilled labor, availability of, say, offshore wind repair vessels. And all of that, of course, translates through to an increased claims burden that we only now see working their way through the P&L with the longer policy durations. But on the other hand, of course, let's not forget we do have mechanisms to actually deal with inflationary pressures, say index clauses on the reinsurance side, say tying of premiums to actual sums insured. So there's mechanisms that we can use to work this through. And we're expecting the pressures to ease a bit, but still they remain elevated compared to pre-COVID times.
Okay, thank you, thank you. Let's switch, Julien, to you on the life and health side, and it is a very complex economic picture. What does that mean from your side of the business?
Well, I think first of all, if we look a little bit at the forecast, and Jérôme gave a bit of an overview there. I think globally, so we forecast further growth for the life insurance premium in the current economic environment. So for the short term. 2 also applies the magic number to life and health, but it's also 2 different stories. So if you look at North America, the US market in particular, and Western Europe, there the growth will be rather below 2%. And the global growth, what is interesting now, is more and more fueled by the emerging markets. And if you look at the reports, a bit at the details of where this growth is coming from, so it's mainly the saving products. And we see especially the APAC region really driving this global growth. And as part of there, China is really the market where, if we look in absolute terms, the growth will come from globally for the insurance premium in life and health. So savings will be the area where we will see the most growth, especially compared to, let's say, maybe more the protection products. So we are relatively optimistic for the life and health industry. Of course, as Jérôme was mentioning, inflation doesn't disappear. So there's still a risk of inflation. and that will put pressure on the buying power of some of the potential policyholders for the future. As well, tightened credit conditions may have an impact, and clearly, if the breadwinners of the family are getting under pressure, they're clearly buying a new life insurance policy may not be the first thing on their mind. But overall, I think we remain quite positive, and to see over the next decade higher growth for the life and health insurance industry than what we have experienced in the past, Anthony.
Mm-hmm. Thank you very much, Julien. So let's just let's sort of pull the lens out a little wider here. I mean, there's no escaping the geopolitical side. Things are really changing there from a risk perspective. And you know, where's that? Is that getting reflected? Do we see it in trade and credit surety, for example? You know, where do we see that?
Yeah, thanks, Anthony. So I'd like to also, building on Julien here, distinguish two factors in the context of deglobalization that are really important for us. On the one hand side, it's global supply chains that we've seen restructuring and changing, like with the Mexico example for the US a moment ago, where we need to reflect in the transportation lines as well as in other lines of business just the changing nature of the underlying trade flows, the changing nature of the underlying risks. If you then translate that through to reinsurance mechanisms, that may mean that in terms of accumulation, tracking, and peak exposures, we just have different focus points to keep in mind and to manage. That means that we need to have increased transparency on the types of risks that we underwrite to make sure that we stay on track with the changing risk landscape. But then lastly, in the context of changing supply chains, let's also not forget that there's a very real economic opportunity attached to it through the restructuring that will mean investments into different infrastructures to support these changed supply chains. Right. So that's the one nuance here in the context of deglobalization. And then, of course, the second one is if we look at the geopolitical environment, if we look at the record number of elections that are coming up next year, and an increased level of global tensions on a number of different levels. Of course, in the specialty lines, we do provide coverage for war and warlike perils, so we see an elevated risk landscape. And we see an increased need, perhaps, over what we had in the last decade to just stay on track of these exposures and monitor them. Those, of course, then do reflect back also into the risks that we're covering. So if we look at the Red Sea at the moment and at trade routes, we now hear that about 90% of vessels are choosing the safer route across the Horn of Africa. That means on the one hand side, exposures that are very risk exposed are dropping off. But on the other hand, of course, this increases transport times, so it increases prices. It increases exposures in different ports than we would have seen them otherwise, and it's just a factor to manage. If I look back, though, we've been writing specialty insurance as an industry for 160 plus years. So inflation, disinflation, global tensions, they're not new, right? We just need to remember what we already dealt with a generation or two ago and sort of refresh that. Luckily, we've got different digital means, different data that we can access now. So I'm super confident that we can address those challenges in a positive way, provide security around the terms that we're offering, and advance through these trigger points as an industry.
All right, thank you, thank you. And Julien, over to you. What about the in-force business, for example?
Well, in-force business, I think, Anthony, this is a good moment to have a life and health in-force book in a still higher interest rate environment. Clearly, then this is usually helping the profitability of the life and health insurers, as reinvestment yields are much more attractive, of course, and we see that in general. So this is a good thing. On the flip side, when interest rates are higher and where saving products are becoming more attractive for the customers, we also see an increased lapse risk developing as maybe some of the existing policyholders will consider new products and switching over a more attractive or higher yielding product for the future. This is one area. Another area, if we look at the in-force, is clearly for the insurers, the cost of funding future growth or financing new projects is also increasing. More insurers are looking to using their in-force portfolio as, in a way, a trading tool to get funding. So that means that we see more opportunities for what we call in-force blocks transaction. Some markets like the US or Canada, so UK as well, have been very active in terms of increased in-force transactions. We also see specifically on the annuity books a lot of movement with what we call the bulk annuity market. Will continue to be attractive, and we expect a lot of insurers considering bringing those transactions on the market. So either accessing funds from private equity firms or what the so-called AIB players, but as well the reinsurers on the life and health side.
Thanks, Julien. Thank you very much. So, Anne, sort of a topic of conversation, and you know, a number of global risk reports have been issued at the beginning of the year, and so on. We've, you know, the transition to a green and decarbonized economy is, it seems, unescapable, and a good thing too. What does this mean for you and your clients?
Thanks, Anthony. So definitely for us, you know, I would say it's the topic of the decade, especially if you look at the engineering and the marine and energy lines. Swiss Re Institute have pegged the economic opportunity that's tied to this at order of magnitude 240 billion in insurance premiums, I think, over the course of a decade. So it's a mind-bogglingly large number. But if we take a step back, of course, what has triggered the whole push towards green energy is concerns around the climate. But the climate is also relevant for decarbonization and for green technologies in a sense that it presents a threat that I think is sometimes overlooked. So if we look at things like recently in the UAE, we've had unprecedented sandstorms that damaged solar panels in a really big way. We have hail losses associated to solar power. So, you know, new and emerging weather and climate patterns threaten some of the investments that we're making in renewable energies in a way that perhaps we haven't foreseen. Our climate models are historically built for property, so exposures that are on land and that don't move. So we need to make sure we expand those into the areas that are relevant for those decarbonizing technologies. And then last but not least, we keep on building new things. Right? We're expanding the limits of insurability as we're learning about the underlying risks of those new technologies. For us, where we see both our responsibility towards society, but also a big economic opportunity for insurers and reinsurers, is to invest into our understanding of those technologies, to invest into our understanding of the underlying risk landscape and of ways of managing that. That's where we think we can contribute. So there's the whole data-driven part, and then of course there is the insurance and reinsurance contractual part where we need to continue investing, make sure that we are covering the risks that our policyholders expect us to cover so that we can facilitate that huge change that we as a society need to undergo. So it's front, right, and center for us, has been, is, will be for the next few years.
Yeah, and just briefly, you've established a centre of competence, I believe, on...
Yes, we did. We did establish a centre of competence around renewable energy. What is really important to us, it spans through several traditional lines of business, because what we're seeing is that a number of the underlying, the players in the underlying industry that have been traditionally engaged in hydrocarbons are investing into green technology. They are actually the biggest investors in that field. So what is really important is that we bring together the learnings and also the practices, sort of best of different worlds out of the different lines of business and the underwriting there, and make sure that we offer a holistic and a seamless service to our clients in those emerging fields.
Excellent, excellent. Now I'm going to plunge a little bit off piste here, Julien, with you, and you might not thank me for this, but tell us a little bit about the topic of mortality, because that's really something that you've been thinking about recently, is it not?
Yeah, well, thanks for the question. And this is the most important, I would say, topic with my Chief Underwriting Officer hat in Life and Health. Clearly, we need to better understand the true causes of the recent, let's say, elevated mortality coming out of COVID. So COVID-19 is not gone, but clearly what we see in terms of the impact of the mortality on the population is that general population mortality remains more elevated than a pre-pandemic level. So what does it mean? It means that we have, or we continue to have, excess mortality in some of the main protection insurance market in the world. So when we saw quite an additional increase in mortality logically during the pandemic, like in some emerging markets like India, South Africa, or China, what we have seen clearly is that during that time, or in those markets, now the mortality has come down almost to the level of the mortality before the pandemic. In other markets like the US, UK, Canada, for example, we continue to see different level of excess mortality, about 5 to 10%, again for 2023. This means additional claims cost for the life and health insurers and the reinsurers, as for Swiss Re. And if we look at the causes for this excess mortality, the trends that are starting to emerge are the following. Of course, there is a bit of a, if you allow me to use the expression, COVID-19 hangover. So we still have COVID cases, and people are still entering hospital because they are sick and have a higher risk of dying. But the hangover is also the impact and the pressure on the healthcare system in some of the market that have not recovered. And as a bit of a domino effect, probably as well having an impact on prevention for some disease, cardiovascular disease, or even on the cancer front. And there we see that number of deaths due to a heart attack or due to specific cancers are on the rise. Clearly something that for the short term we do care very much about, and where we see that this excess mortality will probably take a few years to, let's say, decrease and hopefully come back to the pre-2020 level. On the long run, and the Swiss Re Institute and the Life and Health R&D team have produced a paper last year about the future of life expectancy. So you may ask, what about the future, right? Well, in the future, our views remain positive. So we are, we continue to be bullish about the future prospect of improving or increasing life expectancy for the world population in general. Why that? Well, first and foremost, medical progress and medical advancement will continue with the new technology, what has been developed during COVID, the vaccination, and what those type of vaccine could help achieve on the cancer front will certainly, over the next 15 to 20 years, help society to further improve the, let's say, effectiveness of the treatment or the prevention for cancer disease and the resulting number of deaths from those diseases. In addition, if we think about the biggest gain of life expectancy coming out of, let's say, the 60s and the 70s, it was clearly a behavioral factor, reduction of smoking prevalence. So if you think about, let's say, for my age, when I was growing up, the amount of smokers in my family or just in general was much higher than the amount of smokers today. Today is one of the biggest source of poor health and poor metabolic health is the prevalence of obesity and diabetes. Clearly, if you assume that in the future there is a reverse of that trend, first it has to stop increasing, but a reverse of this trend and a general improvement in society for health and a decrease of obesity, then clearly this will lead to potentially major future gains of life expectancy and mortality improvement. And Swiss Re remains positive that this will happen over time.
Thank you very much indeed, Julien. Well, look, we're getting close to the end of time. What I'd quite like to do, if you'll indulge me, is that I'll just quickly wrap up, and then we've got a couple of questions here as well. And actually, we'll do, after the wrap up, we'll do the questions, and then we'll wrap up, if that's okay. That's okay with you. So thank you very much indeed to those of you who have joined us and need to just leave at the end of this half hour. We will send you a recording and some relevant content on the basis of the conversation that we've had so far today. What I want to do, we have got some good questions though, and I'd like to get to those. The first one, and I think I'm going to direct this to you, which is about how about the complex risk. This is from Gabor Hanek. How about the complex risks stemming from the de-risking process across markets?
Stemming from the de-risking process about markets. I'm afraid I'll draw in all of your support to kind of interpret the different nuances of this.
Yeah.
You know, when I look at I think one of the obvious examples, and we touched on it, is if we look at deglobalization and sort of the risk landscape associated with international trade. We have exposure patterns sort of falling off where we see elevated risk, such as in the Black Sea or in the Red Sea. We just need to keep on monitoring those, right? And make sure that we not only can track things after they occurred, but hopefully can also look forward and do a bit of predictive modeling in order to make sure that we're on top of it. But inviting the colleagues to add to those things.
Very happy to add, and thank you for proposing the de-risking. I think you nailed it. And the way I think about it is there has probably been never a more important time for the insurance industry than now to provide resilience. Why? Because we really need it. Why do I say that? If you look at protection gap estimates that Swiss Re Institute provides, the global protection gaps are at record high levels, about 1.6 trillion in premium equivalent terms. So we really need to de-risk, and we need to make sure that protection gaps narrow. We need to de-risk global supply chains, as you mentioned. And as you mentioned, this will need new investments. And we are also investors, the insurance industry are also long-term investors. And decarbonization, it's not just about greening the economy, but also at the end of the day, it's about ensuring energy security. And that's also about de-risking dependency to a certain form or certain countries in terms of energy provisioning. So I think the de-risking team, it cuts across all aspects of the economies and all aspects where the insurance industry is also actually involved. Maybe the last point on supply chains. We have, I mentioned like deglobalization. However, it's rather a re-globalization. We will always have supply chains. They just, the patterns are just changing, and that's also very much a de-risking effort that we are seeing. But again, as you point, and that will need new investments, and that also means new insurance opportunities and risk pools coming aboard.
Okay. I've got a question here for you, Julien, and it's, do you think that the difficulties in accessing healthcare could be contributing to this COVID hangover?
Yeah, thanks for the question. Yes. The question is how long this will last. So I think what we are quite busy with our R&D team now is looking, so we see this excess mortality, which is in some cases, as I was saying, so the hangover from COVID. But as well, in some countries, we see the healthcare system really under pressure. And the combination of both is certainly not helping in terms of the short-term trend for the mortality improvement. So in the short term, I think we will see more volatility. And Anthony, for the question, is on target. Right? I think they are linked, of course. There's also the COVID hangover. Also means that we have less people currently willing to work all the extra hours in some of our hospitals or retirement home, and clearly there's a shortage of employees, of doctors in some areas or in some countries, and this is something that is certainly not helping for the prospect of short-term mortality improvements or, let's say, health quality in general.
All right, thank you very much. Jérôme, this one's for you from Gabriella Winter. What might change our economic outlook? Are there any scenarios? What are I mean, you often think in scenarios, don't you? I think, tell us a little bit about this, sort of a couple of the scenarios you see.
The couple of scenarios that we are watching is A, stagflation. Stagflation meaning growth is coming down, but inflation pressure remains high. Now what we are seeing is disinflation, and we will have to see whether the pressure on the service price inflation as well as wages that I mentioned before, whether that's going to be easing. Stagflation scenario like the one that we had seen in the 1970s, however, I see as being very remote. It was, I would have attached a higher likelihood 1 or 2 years ago, but then central banks acted and acted extremely forcefully in hiking. So stagflation definitely is one of the scenarios we should keep watching, even though it's more remote. We could see milder stagflationary scenarios out there. And second, obviously, global recession. We are in untested and uncharted territory. Let's not forget, and it's not because we didn't have a recession in the US that we could not have it this year. Having been 15 years plus in a low to negative interest rates environment, it means that that the market, be it households, be it corporates, they have locked in their mortgages, their debt at low rates, but they will need refinancing. I don't see an issue for refinancing for IG credit this year. However, if you look at the real estate sector, refinancing in real estate, especially in Europe, about 60% of the real estate financing is due over the next 2 years, 2024 and 2025, meaning higher interest rates will start to bite. So these are definitely two key scenarios. And then on top of that, the election year, political risk, that will add to the uncertainty of the outcomes.
Yeah, and on the R word, the yield curve still inverted, right, in the US?
Yield curve is still inverted, correct. I would expect, however, with central banks starting to cut this year, 100 basis points, around 100 basis points, a little bit more in the US this year, but also by the ECB, that the yield curve will start actually to be steeper again, as it used to be. So I don't see the yield curve as a great recession indicator for the US.
All right. So just and let me weave James van der Vaart's question here. So what macro risks? Maybe we'll start with you, Julien. What macro risks are you looking at from your perspective?
Well, I think coming back to the general economic environment, it's clearly. So the inflation risk is still there, although I recognize the statement and the inflation trend that Jérôme was mentioning. So for us, clearly on the life and health side, this is something that we follow closely, and as well, what are the risks mainly on the possibility for the people to buy the capacity to further buy new insurance products. So reducing the protection gap will work if people are able to buy more insurance. So the number of new clients is highly dependent on their capacity to afford to buy a new life and health insurance policy. And therefore, this is a little bit those pressure points. And clearly, I think we will see global economic growth and as well global growth of the life and health insurance market. But clearly, this depends about on the buying power of our future customers.
Thank you. And Anne, from your side?
Yeah, thanks, Anthony. So I think for the specialty areas, I would distinguish kind of two different groups there if we look at scenarios. So one is the ones that we've seen, and they keep on coming, but they're not sort of the one-time big events. They're rather sort of have impacts at different points in time. That's around Nat Cat that we spoke about. It's also around social inflation that we touched a bit less, but they're just up and coming. And then I think in terms of sort of big scenario type events, if we look at geopolitical tensions, and if we look at inflation, and if we look at possible events that combine, different elements there, I think that for us is just a big scenario that we're very actively watching and that we're managing exposures towards.
Yeah. All right, that's great. Well, look, on that macro note, I think we'll probably wrap it up from there. Thank you very much indeed, Jérôme and Julien, very much indeed for your indulgence on this. We meet again this afternoon for US time, and I thank you very much indeed to you, our audience, for joining us today. Like I said, we'll send you a copy of the recording of today's call and today's webinar, and some associated collateral. But thank you very much indeed for joining us, and we look forward to seeing you in due course. Thank you. Bye-bye.